Hey there, Investing Iguanas. Iggy here. Today, we're tackling a hot topic in the Singapore stock market, REITs. You've probably heard about their recent struggles. High interest rates, work-from-home trends, governance issues. It's been a rough ride. But don't worry, because in this video, I'll break it all down for you. We'll look at what's ailing Singapore REITs and, more importantly, the reforms that could shake things up and revive this crucial sector. Stick around, because by the end, you'll have a clearer picture of where S-REITs stand and where they might be headed. Let's dive in. First up, we've got high interest rates. When interest rates go up, it becomes more expensive for REITs to borrow money and finance their operations. This puts pressure on their bottom line and can make investors a little skittish. The second big factor is the global shift towards working from home. With more people ditching the office and setting up shop at home, there's less demand for the office spaces that many REITs rely on. This trend has really put a damper on investor enthusiasm for REITs. But hold on, it's not all doom and gloom. There's a glimmer of hope on the horizon. The U.S. Federal Reserve is starting to ease up on its monetary policy, which could help lift some of the clouds hanging over REITs. As interest rates stabilize or even start to come down, borrowing costs for REITs will become more manageable, and investor confidence could start to rebound. However, there's another pesky issue holding back a full recovery, and that's the governance of Singapore REITs. You see, the playing field is currently tilted in favor of sponsors, the companies that create REITs by contributing their properties. This imbalance in power can sometimes lead to conflicts of interest and decisions that may not always be in the best interest of unit holders. That's fancy speak for REIT investors like you and me. You see, the playing field is currently tilted in favor of the sponsors, the firms that create REITs by contributing their properties. This imbalance of power needs to be addressed for investor confidence to fully return. Sponsors often have significant control over the REITs they create, including the ability to appoint the external management company. This can lead to potential conflicts of interest, as the sponsor may prioritize their own interests over those of the REIT's unit holders. A prime example of this power imbalance is the case of Sabana Industrial Real Estate Investment Trust. Activist investor Quore's Capital Management launched a successful campaign to remove the REIT's external manager, which was owned by the sponsor ESR Group. Quore's argued that internalizing the management function by appointing a subsidiary of the trustee would lead to significant cost savings for unit holders, as it would reduce the fees paid to the sponsor. This move was a major victory for Sabana REIT's minority shareholders who had previously expressed concerns about the sponsor's influence over the REIT's management. The Sabana REIT case highlights the potential benefits of internalizing management for REITs, a practice that is more common in Europe and North America compared to Asia. By aligning the interests of the management with those of the unit holders, internal management structures can help mitigate conflicts of interest and improve overall governance. However, the process of internalizing management can be complex and time-consuming, as demonstrated by the ongoing challenges faced by Sabana REIT in implementing the change. To address these issues and restore investor confidence, regulators and industry stakeholders must work together to implement reforms that promote greater transparency, accountability, and alignment of interest between sponsors, managers, and unit holders. This may include measures such as mandatory disclosure of related party transactions, increased board independence, and clearer guidelines for the internalization of management functions. By leveling the playing field and empowering unit holders, these reforms can help ensure the long-term sustainability and growth of the REIT sector in Singapore and beyond. In most of Europe and North America, REITs are typically structured with internal management, meaning the REIT itself employs the management team. However, in Asia, it's far more common for REITs to outsource their management functions to external companies owned by the REIT's sponsor or major shareholder. This external management structure has come under scrutiny due to potential conflicts of interest and additional fees paid to the sponsor-owned management firm. The case of Sabana REIT in Singapore has emerged as a potential turning point. The proposed change involves creating a subsidiary owned by the REIT's trustee to handle key functions like property acquisition, disposal, and redevelopment. This would reduce fees paid to the sponsor-owned manager and could set a precedent for improved governance in other Asian REITs. However, the transition has been far from smooth. Nearly a year after the unitholder vote in favor of internalization, there is still significant uncertainty around when and how the trustee can implement the proposed changes. The process has been costly, with legal fees already exceeding $3 million, a hefty sum for a trust with total assets of just $1 billion. The delays stem from conflicting opinions and guidance from key stakeholders. The stock exchange regulator and the High Court have offered differing views on the necessary steps and regulatory requirements. Unit holders are seeking to accelerate the process through additional resolutions, while the trustee is still navigating the legal and procedural complexities. Despite these challenges, Singapore REITs are showing remarkable resilience compared to their counterparts in China, Hong Kong, Japan, and Australia. Recent stress tests conducted by S&P Global Ratings reveal that Singapore REITs can withstand significant shocks, such as 20% of tenants not renewing their leases. This resilience is partly due to Singapore's robust property market, which hasn't experienced the same retail slump seen in Hong Kong. While the office market in Singapore is facing some uncertainty and needs to attract new tenants, especially if tech firms pull back, there's no immediate crisis on the horizon. The city-state's strong economic fundamentals and its position as a regional business hub continue to support the REIT sector. In Singapore's property-obsessed culture, individual investors have traditionally been content with rental yields around 4% from residential properties. However, with REITs offering yields between 5% and 8%, there's a growing question of how long investors will ignore these potentially more lucrative opportunities. This yield gap is creating a compelling case for REIT investments, especially as reforms are being considered to address governance issues. The time is ripe for changes that would curb the dominance of REIT sponsors and empower unit holders, creating a more balanced and transparent market. Activist investors, such as Quartz Capital Management, have already made significant strides in this direction, successfully campaigning for changes in REIT management structures. The courts are also playing a crucial role in interpreting and shaping REIT regulations. Now, the ball is in the regulator's court to implement reforms that could revitalize the sector, potentially including measures to improve disclosure requirements, reduce conflicts of interest, and enhance unit holder rights. These changes could not only boost investor confidence but also position Singapore REITs for sustainable growth in the evolving global real estate market. All right, Investing Iguanas, we've covered a lot of ground today. We've seen how Singapore REITs have been grappling with challenges like rising rates and governance conflicts. But we've also explored the potential for reforms to level the playing field and put REITs back on track. The road ahead may be bumpy, but with the right changes, S-REITs could once again become an attractive option for yield-hungry investors. As always, do your own research and keep a close eye on how these developments unfold. If you found this video helpful, give it a like and subscribe to the Investing Iguana channel for more insights into the wild world of investing. Until next time, stay savvy and keep investing wisely.